The cracks begin to show. It began quietly, as these things often do. A bankruptcy filing here, a default notice there. First Brands Group, a name few outside finance circles knew, suddenly made headlines. Then came Tricolor Holdings, an auto lender once hailed as the future of subprime innovation. Both collapsed within weeks. Different businesses, same pattern. Too much leverage, too little transparency, and financing pipelines running through an increasingly fragile web of private credit. First Brands, buried under billions in debt, couldn't refinance. Tricolor, serving underbanked borrowers, had allegedly double-pledged collateral and overstated its receivables. Banks were hit too. One regional bank wrote down nearly $170 million in losses from Tricolor alone. On paper, these were isolated incidents. In reality, they revealed a shadow system so large that even Wall Street regulators can no longer map it completely. Welcome to FluxFolio Finance. Today, we pull back the curtain on America's non-bank financial system, a universe bigger than banking itself, and why its quiet tremors could one day shake the global economy. What exactly is private lending? Private lending, sometimes called private credit, is the business of financing companies without going through traditional banks or public bond markets. It's where pension funds, hedge funds, insurance companies, and private equity giants lend directly to businesses, often small or distressed ones, in search of higher returns. The scale is staggering. In 2010, the global private credit market was about $350 billion. By 2025, it surpassed $2.1 trillion, more than 5 times larger. In the US alone, it's now roughly 10% of total corporate lending and growing. The appeal is obvious: higher yields, flexible terms, and fewer regulations. For borrowers locked out of bank loans, private funds are lifelines. But the trade-off is opacity. These loans aren't traded publicly, disclosures are limited, and valuations rely on models, not markets. When everything's fine, this model looks brilliant. When funding dries up, it becomes a blind spot in the financial system. Beyond banks, the rise of the NBFI empire. To understand why this matters, we have to see the bigger picture: the rise of non-bank financial institutions, or NBFIs. Think of them as the parallel banking universe. Insurers, pension funds, asset managers, hedge funds, money market funds, and private credit vehicles. Collectively, they now hold assets worth over $60 trillion in the US, more than 400% of GDP, roughly 4 times the size of the regulated banking system. Banks, by comparison, sit on assets equal to about $25 trillion, just over 100% of GDP. So yes, most American finance now happens outside traditional banks. And while banks report capital ratios, undergo stress tests, and answer to the FDIC, these shadow lenders largely don't. The Financial Stability Board calls this non-bank financial intermediation. It's vital for economic growth, but also a transmission network for risk. Money flows from pension funds to private equity firms, to CLOs, to insurers, to fintech lenders, and eventually back into the banking system via loans, repos, and derivatives. A web so dense that no regulator can say exactly where the weak link lies. Why the Fed is watching closely. Since 2023, the Federal Reserve and FSOC, the Financial Stability Oversight Council, have quietly intensified monitoring of NBFIs. The reason? Interconnectedness. Banks may not own these funds, but they fund them through credit lines, derivatives, and repo facilities. A Moody's report in late 2025 found that U.S. banks' loans to NBFIs now represent 10.4% of all bank lending, up from 3.6% a decade ago. That's around $300 billion directly exposed to the shadow system. And that doesn't include off-balance sheet commitments or structured deals. When liquidity is abundant, this symbiosis works. But when markets tighten, like now, after 2 years of high interest rates, the feedback loop becomes dangerous. A margin call in a private credit fund can force asset sales, which pressure valuations, triggering more margin calls until the tremor hits the banks themselves. Sound familiar? That's how the 2008 crisis began. Only then, it was subprime mortgages. Today, it could be subprime credit funds. The warning signs: we're seeing early symptoms. Liquidity stress. Banks have been borrowing more from the Fed's standing repo facility and discount window, over $15 billion in just 2 days in October 2025, the highest since the pandemic. That's a sign some banks are quietly struggling for short-term liquidity. 2. Opacity in valuations. Private credit funds mark their loans quarterly, often using optimistic assumptions. When rates rise or defaults increase, reported values lag reality. 3. Credit deterioration. Default rates in the leveraged loan market have crept toward 3.5%, still manageable, but trending higher. If the economy slows, those defaults could double. Regulatory data gaps. The Fed itself admits it lacks granular data on where non-bank leverage truly resides. That means the system's weakest points might only become visible after they break. Why this could become systemic. Here's where it gets serious. If an NBFI, say a major private credit fund, suddenly can't roll its debt, it may be forced to dump assets at fire sale prices. Those assets, often corporate loans or structured notes, are held by banks as collateral. When prices plunge, collateral values fall, forcing banks to take losses or call in other loans. That's contagion. This is not theoretical. During March 2020, money market funds froze, forcing the Fed to launch emergency facilities. In 2022, the UK pension crisis nearly toppled gilt markets when leverage in LDI funds backfired. And in 2025, we're seeing smaller versions of that same movie playing out through trickle-down-like collapses in private credit. Regulators call this liquidity mismatch, borrowing short, lending long, with no backstop. Banks can turn to the Fed in a crisis. Non-banks can't. So when panic hits, they sell, and prices spiral. Even if only a handful default, the signal to investors is clear: the illusion of safety is gone. And since NBFIs now intermediate more credit than banks, the consequences ripple across the entire economy: higher spreads, tighter lending, slower growth. A credit crunch, born not inside the banking system, but just outside its perimeter. How the US regulates the shadows. So what is Washington doing about it? The US regulatory framework for NBFIs is fragmented. The SEC oversees funds and asset managers. The CFTC monitors derivatives. The Treasury's FSOC can designate systemically important non-banks. But since 2019, only a handful actually carry that label. Insurers are largely state-regulated. Private credit funds, virtually unregulated. There are signs of change. The SEC has proposed liquidity management rules for open-ended funds. The Fed and Treasury are exploring a centralized data hub for non-bank exposures. Some policymakers are floating the idea of requiring large private credit managers to hold capital buffers, similar to banks. But the progress is slow. The challenge isn't just regulation, it's visibility. You can't supervise what you can't see. The macro backdrop overlay this with today's macro environment. High interest rates, sticky inflation, and elevated corporate leverage. Roughly $7 trillion in U.S. corporate debt matures between 2025 and 2028. Much of it issued when rates were near 2%. Refinancing that debt at 6 or 7% will strain balance sheets, especially for smaller borrowers reliant on private credit. At the same time, the Fed's balance sheet has shrunk by $1.5 trillion since 2022, the most aggressive quantitative tightening in history. Liquidity has left the system just as credit risks are rising. That combination, high leverage, lower liquidity, limited transparency, is precisely what turns idiosyncratic defaults into systemic shocks. So while regulators classify current risk as low to moderate, the trajectory is unmistakable, upward. Lessons from history. Every financial era has its blind spot. In the 1980s, it was savings and loans. In 2008, subprime mortgages. In 2025, it might be private credit and non-bank leverage. Each time, the same story. Innovation outpaces regulation. Returns look safe until they aren't. Investors chase yield, complexity grows, and somewhere in the shadows, liquidity disappears. The difference today is scale. NBFIs aren't niche anymore. They are the system. And while the banking sector is better capitalized than ever, it's tethered to a shadow world 4 times its size. If that shadow trembles, the light won't stay untouched. So what happens next? Will this cause a 2008-style collapse? Probably not. But the risk of a rolling credit shock, sector by sector, fund by fund, is rising. It won't be one explosion. It'll be erosion. Higher defaults, liquidity squeezes, and the slow tightening of credit availability. The Fed can extend liquidity, but it can't bail out every fund. Transparency reforms will help, but only if data arrives before the crisis, not after. The system's safety, paradoxically, depends not just on the banks, but on the institutions that aren't banks, yet act like them every day. And until those institutions face equal scrutiny, the phrase financial stability will always come with an asterisk. If you found this breakdown useful, hit like, share your thoughts below, and subscribe for more deep dives into the forces shaping global finance. Because the next crisis may not start where you expect, and on FluxFolio Finance, we're here to spot the tremors before the quake. Stay sharp, stay thoughtful, stay ahead.